The architecture of the global financial system is a complex and perpetually evolving entity, a web of interdependencies and leverage built upon a foundation of confidence. It is a system that can appear indestructible in times of expansion, yet its fragility is exposed with stunning rapidity when key structural supports are compromised. The confluence of two specific and historically significant economic forces, an unprecedented global debt burden, and a deliberate pivot towards aggressive protectionist trade policies creates a plausible and perhaps inevitable catalyst for a systemic crisis of a magnitude not witnessed since 2008 or even 1929. This analysis posits that the period leading into 2026 represents a critical juncture, where these forces are not merely aligned but are actively reinforcing one another, creating a feedback loop of contractionary pressure capable of unraveling the very fabric of global commerce and finance. The assertion that $38 trillion in debt coupled with a resurgent wave of Trump-era tariffs will destroy everything is not apocalyptic hyperbole, but a stark assessment of the terminal velocity that a debt-deflationary spiral can achieve when fueled by policy-driven disruptions to global supply chains and corporate profitability. To understand the gravity of the $38 trillion debt figure, one must first dissect its composition and the mechanics of its sustainability. This debt is not a monolith. It is stratified across sovereign governments, non-financial corporations, and households. At the sovereign level, developed nations, particularly the United States, have engaged in over a decade of deficit spending, a policy initially justified as a necessary response to the great financial crisis, and later exponentially accelerated by the fiscal demands of the COVID-19 pandemic. The result is a national debt-to-GDP ratio that has crossed into territory historically associated with diminished returns on fiscal stimulus and heightened vulnerability to rising interest rates. The critical pivot point occurred when central banks, led by the Federal Reserve, were forced to abandon the zero interest rate policy, ZIRP, and quantitative easing, QE, paradigm of the 2010s in response to surging inflation. The transition from a low rate to a higher rate environment is the single greatest threat to this debt edifice. The cost of servicing existing debt skyrockets, forcing governments into a brutal trilemma: enact politically toxic austerity measures, print money to monetize the debt and risk hyperinflation, or allow debt to accumulate uncontrollably, crowding out productive public investment and undermining long-term growth. The U.S. Treasury, as the issuer of the world's primary reserve currency, has thus far been insulated from the immediate solvency crises that plague emerging markets. But this privilege is not absolute. As debt service consumes an ever larger portion of the federal budget, it erodes international confidence in the full faith and credit of the U.S. government, potentially triggering a buyer's strike at Treasury auctions and forcing a destabilizing repricing of the global risk-free asset. The corporate debt segment of this $38 trillion is equally, if not more, precarious. The eras of cheap capital created a perverse incentive for corporations to engage in financial engineering on a massive scale. Leveraged buyouts, share buybacks, and mergers and acquisitions were funded not through organic profit growth, but through the issuance of historically high levels of debt, much of it in the form of leveraged loans and BBB-rated corporate bonds, the lowest tier of investment grade. This created a systemic vulnerability concentrated in the corporate bond market. Corporations that loaded their balance sheets with debt under the assumption of perpetual low rates now face a double-barreled threat: rising interest expenses that compress profit margins, and critically the need to refinance maturing debt in a market where credit is more expensive and less readily available. A significant volume of this corporate debt is scheduled to mature in the 2025-2027 window, creating a maturity wall. If the prevailing interest rates at that time are substantially higher, the refinancing process will act as a powerful brake on corporate investment, hiring, and expansion. Weaker, zombie firms, those unable to cover their interest payments from operating profits, will face bankruptcy, triggering layoffs and losses for creditors. This is not a marginal phenomenon. The sheer scale of the corporate debt market means that a wave of downgrades from BBB to junk status could precipitate a fire sale, as many institutional investors are mandated to hold only investment-grade securities. The resulting credit crunch would starve even healthy companies of capital, contracting the real economy. Enter the second actor in this tragedy: the return of comprehensive adversarial trade policy. The modern global economy is not a collection of isolated national economies. It is a deeply integrated system of complex supply chains. A smartphone assembled in China contains components from Japan, South Korea, Taiwan, and the United States. An American automobile is built with parts from Mexico, Canada, and Germany. This system, optimized for efficiency and cost reduction over 4 decades, is exquisitely sensitive to disruptions at its nodal points. The implementation of widespread tariffs, as championed during the Trump administration and proposed for a potential second term, represents a deliberate and massive disruption. The economic logic of tariffs is straightforward. They are a tax on imports, raising costs for domestic consumers and businesses while providing protection for domestic producers in specific sectors. However, the real-world effect is far more complex and damaging than this simplistic model suggests. When the United States imposes tariffs, such as the proposed 10% universal baseline tariff or more aggressive targeted tariffs of 60% or higher on Chinese goods, it does not operate in a vacuum. It invites immediate and proportional retaliation. China, the European Union, and other trading partners would not absorb these costs. They would respond in kind with tariffs on American exports, particularly on politically sensitive agricultural goods like soybeans and wheat, as well as manufactured products and services. This tit-for-tat escalation initiates a destructive cycle that economists term a trade war. The initial effect is a surge in costs for businesses that rely on imported components, squeezing their profit margins. These increased costs are then passed through the supply chain, ultimately manifesting as higher consumer prices for a vast array of goods, from electronics and clothing to food and automobiles. This import price inflation creates a devastating policy dilemma for central banks. The standard tool to combat inflation is to raise interest rates. But in an economy already straining under the weight of $38 trillion in debt, further rate hikes would accelerate the corporate default cycle and deepen the potential sovereign debt crisis. The central bank is thus caught between the Scylla of persistent inflation and the Charybdis of triggering a financial collapse. This is the dreaded stagflation scenario of the 1970s, but with a critical, modern exacerbant, a vastly more leveraged financial system. The uncertainty generated by a trade war also causes businesses to freeze capital expenditure. Why build a new factory or launch a new product line when the rules of global trade are in daily flux and your supply chain costs are unpredictable? This collapse in business investment is a direct hit to productivity and long-term economic growth, further depressing corporate earnings and equity valuations. The true systemic risk, however, emerges from the interaction of the debt bubble and the trade war. They are not separate crises occurring in parallel. They are synergistic, each amplifying the destructive potential of the other. Consider the transmission mechanism. A trade war-induced surge in costs and a simultaneous slowdown in global growth lead to falling corporate revenues and profits. For heavily indebted firms, this is a lethal combination. Weaker profits make it harder to service existing debt, leading to a spike in defaults and downgrades. This triggers a repricing of risk across the entire corporate bond market, leading to a credit crunch. The credit crunch then starves businesses of the working capital they need to survive the very downturn that the trade war caused, leading to more layoffs, reduced consumer spending, and further economic contraction. This is the debt-deflationary spiral, but initiated by a supply-side shock from trade policy rather than a pure demand-side collapse. Simultaneously, the financial markets, which have become accustomed to a world of ample liquidity and central bank backstops, would face a hurricane of correlated losses. Equity markets, which are ultimately a reflection of future corporate earnings, would reprice violently downward as the reality of compressed margins, and a global recession sets in. The volatility would be exacerbated by algorithmic and passive investment strategies that dominate modern trading, leading to flash crashes and a breakdown in market liquidity. The US dollar, contrary to conventional wisdom, could experience a wild, violent ride. Initially, it might surge as a safe haven asset, but this flight to quality would be a double-edged sword. A stronger dollar makes it even more difficult for emerging markets which have borrowed trillions in dollar-denominated debt to service their obligations, potentially triggering a wave of sovereign defaults abroad that would ricochet back onto the balance sheets of large international banks. The repo market, the plumbing of the global financial system, could seize up as it did in September 2019, but this time without a central bank possessing the clear mandate or tools to provide a swift rescue, as its focus would be torn between fighting inflation and preventing a meltdown. The conclusion is therefore inescapable. The $38 trillion debt mountain represents the dry tinder scattered throughout the global economic system. The implementation of widespread adversarial tariffs represents the lit match. The fire that would ensue would not be a simple correction or a mild recession. It would be a systemic crisis that destroys wealth on a generational scale, unravels the globalized supply chains that underpin modern production, and shatters the credibility of central banks and governments. It would destroy, not in the literal sense of physical annihilation, but in the economic sense. Destroying retirement savings, destroying business viability, destroying trust in financial assets, and destroying the post-war liberal international order that, for all its flaws, facilitated an unprecedented period of global growth and poverty reduction. The warning signs are not hidden. They are etched in the stark numbers of debt to GDP ratios and in the clear intentions of populist trade policy. The year 2026 is not a prophecy, but a projection, the point at which these long gestating forces reach their maximum and likely unsustainable tension.